In this video, we're going to be talking about balance transfers, and in particular balance transfers for things like credit cards and personal loans, and how you can use them to pay down your personal debt faster. So in this lesson, we're going to cover what a balance transfer actually is, how you can do it, and some of the tips and traps that you need to look out for. So firstly, why use balance transfers for your debt? Well, the interest that you pay on your debt is effectively dead money because it gives you no benefit. It doesn't reduce the amount that you owe. It doesn't give you any other benefits. So using a balance transfer allows you to reduce the amount of interest that you're paying so that every dollar that you pay onto your debt reduces the amount that you owe. What a balance transfer actually is it's a new debt, either a credit card or a personal loan with a very low or most commonly 0% interest payable. It allows you to transfer existing debt that you have. So if you owe money on an existing credit card and you're paying standard interest rates of between sort of 15 and 20%, you can transfer that to the balance transfer card or the balance transfer loan by paying out the existing debt that you've got. Most banks offer these days, in Australia at least, and that's because there are some traps to look out for, and I'm going to step you through what they are. So first thing, I just want to mention, you do need to actually qualify for the loan. You need to be able to borrow. You need to have, income and in some cases assets that can back up your ability to borrow. The banks won't just give this to you if you can't afford it, and you need to generally apply for the balance transfer or the debt facility to be able to do this. One of the things that you need for this is generally a good repayment history on your existing debt. So if you've got existing debts, it's really important that you're making at least your minimum payments and making them on time. So how does this actually work? Well, I've set up an example here with some existing debts to show you what the numbers could look like and how you can make this work for you. In this example, we've got 3 credit cards, one with an amount of $5,000 owing, the second with $2,000, and the third with $10,000. Doesn't really matter what these numbers are. They could be less or more. It all works the same, but I've just set this up to show you how it actually works. So in this example, we set up a new balance transfer, either card or personal loan, with a limit of $15,000. And your objective here is to transfer the existing debt that you've got over to the new no or low interest rate facility. You'll see in this example that the maximum limit on the new balance transfer debt is $15,000, which is actually less than the amount that we owe on the other cards. So we're going to need to do some prioritizing. Generally, a good place to start is to look at the debts that have got the highest interest rate. And you see that there's a small debt here of $2,000, which is currently sitting with a 20% interest rate payable. So because the interest payments are the most expensive, the most dead money effectively that you're paying on interest here, this should be the first thing that you transfer across to the new balance transfer card. So we see we move that $2,000 across, and now the balance transfer card or facility has got $2,000 owing at a 0% interest rate, and you've got your 2 existing cards. We then look at what is the next highest interest rate on the other debt that you've got. And in this case, it's the smaller card, which is sitting at a 15% interest rate. So we transfer that across and we see $8,000 remaining on the new balance transfer card or loan that we can still use. But there's a debt of $10,000. So there's not enough of a limit left on the balance transfer card that we can transfer the whole amount. So we can move the money across, but we can only move $8,000 of the $10,000 to bring the new balance transfer amount up to the total limit of $15,000, which is now sitting at 0% interest rate. And then there's still $2,000 remaining on the credit card at the 12% interest rate. But by going through this process, what you've done is you've moved $15,000 of your debt, which you would have been paying almost $2,000 a year in interest payments, over to a new card where you're paying no interest at all, and then you can focus on paying that down, but actually be making headway paying down the amount that you owe, the principal of the debt. So I just want to run through some quick tips with you so that you can get the most out of the balance transfer if you decide to go down that path. First thing I want to mention, if you don't qualify immediately to be able to do a balance transfer, as in if you apply and the banks say no, or you don't think that you'll be able to, then you may need to pay off some of your debt first. And by reducing the amount that you owe on other debts, you actually increase your ability to borrow for any new debts, such as a balance transfer debt. You may also get a lower limit than you'd ideally like, and that's not a big deal. As you see in the example that I just went through, if your limit that you get on the balance transfer debt is less than the total amount that you owe, you just prioritize what you want to transfer across, and then you can aggressively pay down the existing debt with the higher interest rate payable. Really important that you don't spend on your new card, and I'm going to show you why in a second and how that works. The other massive tip here is that you must cancel your existing card. Really important. The banks generally don't do this for you, but if you transfer your money across and you keep your existing cards, it's really easy to fall into the trap of actually spending money on that card again, and then you end up with even more debt than what you actually started with, which is completely against the purpose of doing this in the first place. So as I mentioned, you really don't want to spend your new card because it will cost you. So I'm going to show you how that works. Now I'm going to go to a slightly different example where we've got an existing credit card debt of $5,000 and we get a new balance transfer card with a limit of $10,000. Here you transfer the $5,000 from your existing card to the new card at a 0% interest rate, and you do the smart thing and cancel your existing card. But you can see that on the new card, there's still remaining $5,000 of limit that you could potentially spend. But here's the thing, and this is why the banks actually offer these cards, because they know that so many people fall into this trap. One of the fine print clauses is that any of the new spending that you do on the card is generally at a very high interest rate, often close to 20%. So say in this example, we're spending an extra $3,000 of the $5,000 limit that was available on the new card. That automatically goes to a 20% interest rate. But here's the thing, when you actually pay this card off, when you're making payments on your debt, it doesn't split evenly across the 0% and the 20% debt, and you definitely can't pay off the higher interest rate debt first. In fact, you have to pay off the entire amount of any balance transfer, which is generally at a no or very low interest rate, before you can pay any money off the amount that you owe at the higher interest rate. So the $3,000 in this example that you spend at the higher interest rate gets effectively trapped in your card, and it means that you have to pay back the entire $5,000 before you can pay any of the $3,000, and that whole time you're paying interest at 20% on the extra money that you've spent on the card. So that's why it's really important when you get the card. What I've told a lot of people to do in the past is transfer the money over. You don't even need to activate the card. You definitely shouldn't be carrying it around with you because you want to reduce that temptation. And you don't want to fall into the trap and get stuck paying a whole bunch of interest, because that's why you're doing the balance transfer in the first place. So I just want to step you through what you can do next to make this happen if you choose that this is right for you. The first thing you need to do, make sure that you're making all of your payments on any existing debt on time so that you've got a good credit record with your existing providers. Then look at comparison sites, and I'm going to post a couple of links below this video for different comparison sites where you can look at the balance transfer offers of all of the major banks and all of the credit providers. Then choose the best deal, and then you can use what's called cascading debt repayments to actually pay off your debt faster once you've made the balance transfer. If you haven't already seen the video, check out our other video on how to pay your debt off faster using these cascading debt repayments. And think about whether you can use this method to make it easy for you to actually pay down your debt and eliminate it. If you decide that a balance transfer is for you, it's important that you choose the right provider, the right facility, and there are a couple of things to look out for. So first, I would generally suggest looking for the longest time period possible. These balance transfer offers are typically anywhere from 3 months up to 24 months. To give yourself the most flexibility, you might want to choose a longer time period. Then look for one with no annual fees. You don't want to be stuck paying hundreds of dollars a year in fees on the card, and there are so many cards out there these days that you can get one with no annual fees. So make sure you're paying attention to that when you're looking at the options out there. And the third one is looking for one with no transfer fees. Some of these providers will transfer over an existing balance, but they might charge you anywhere between 1 to 5% of the balance, which can run into quite a lot of money when you're transferring thousands of dollars between debts. So use one of the comparison sites out there, look for these features, and you're going to be well placed to get the most out of your balance transfer strategy. That's it, team. I hope you found this useful. I hope it helps you to pay off your debt faster. We're going to be putting videos out like this in the coming weeks and months, and we've got a bunch of ideas, but if there's anything that you want to know more about or something that you're finding confusing and you'd like us to do a video like this on, please feel free to post any questions that you got in the comments below and we'll make it happen. Bye for now.